It's Brian Preston, the Money Guy.
Is the stock market rigged for the sophisticated, the folks who know a little bit more than the others?
Well, this is the one. I think this is so interesting because I've had a lot of people who tell me, look at Warren Buffett. I mean, we did a show talking about Roth IRAs because the new tax legislation is going to limit who can do Roth conversions and so forth. And, you know, a lot of that legislation was driven by the fact that there was an individual that created $1 billion Roth IRA.
He had, I think it was $5 billion from an investment he made in the late 90s, right?
Yeah, PayPal.
PayPal, that was it. It was Peter Thiel.
So here's what's interesting about this. All of you who write me in the comments and try to troll me and say, look, I thought you said index funds were awesome, but look at Warren Buffett having a big Roth IRA. Look at the founder of PayPal having a big Roth IRA. Do y'all see what the difference is there? These are not investors who bought a company like the S&P 500 or Apple or Google. These are people who either founded a company or straight up bought the company and had a direct impact. I've never said that the S&P 500 is going to compete with your small business or private business that you set up for yourself, and you actually are one of these success stories. Realize there's a lot of carnage on the journey to creating a successful business. A lot of them fail, but the ones that do work, God bless you. I mean, we run a small business that has performed better than the S&P 500, but that's not what we do with our retirement money. That's not what we do with our Roth money. We put that stuff exactly like you do into the S&P 500, other index funds. You too can be successful. So it leads back to the question, do you need to be a sophisticated person to get access to this? And I'm going to tell you, I think the answer is no, because the typical investor just needs to be consistent on how they do it, not come up with a better system. And we actually have data to show this.
Yeah, if you look at the JP Morgan Guide to the Markets, they found that since 2001, the S&P 500, just buying the broad index of the 500 largest companies in this country, has annualized about 7.5%. But over that same time period, the average investor return was only 2.9%. Now, we were talking a little bit in pre-show prep about this, Brian. I love that they used this time period from 2001 until now, because it was a little bit of a unique period. There's a lot of stuff wrapped up in there.
Yeah, I mean, I think it's interesting because when you see 7.5, we all know historically the S&P 500 does a little over 10% if you went back decades. If you went just the last 10 years, it's done over 13.9% per year. But the reason it's 7.5, it's a more muted number, is because this is right about the time. This is right in the middle of the carnage of the dot-com bubble.
That's right.
Plus, it's the Great Recession of 2008. So there's a lot of bad stuff that happened in the 2000s that muted the performance down to 7.5. But also, those same crazy swings in the market impacted behavior of the average investor enough that they only made 2.9%. That's disgusting to me. So I thought about this because we remember the whole question here, the premise is a sophisticated investor going to do better? What if you could come up with the best investment system ever created kind of during this same period? What if you saved up money, you built up cash every month, and then you waited to deploy that money right as the market hit a bottom, meaning it hit the dead bottom of a bear market. Then you deployed and invested money. I bet you could make a fortune if you had that ability.
So let's test that, Brian. We know that in 1980, the average income was about $12,500. So if in 1980 you were a financial mutant saving 25% of your income, you would save about $260.70 per month. And just like you said, you've got it figured out more than everyone else. You know exactly when the bottoms are going to happen. So you're going to invest on October 19th of 1987, Black Monday. You're going to invest in wartime. You're going to invest at the bottom of the dot-com bubble. You're going to hit the very bottom of the Great Recession housing crisis. And then you're even going to throw your money into the market starting at the COVID crash. So what you're going to do is you're going to build cash, that $260 a month, every single month until that bottom day, until that low of the market, and then you're going to deploy it. So what that means is that you build up cash and you buy, and you build up cash and you buy, and you build up cash and you buy, and you build up cash and you buy. Well, at the end of this period, from 1980 all the way until 2020, you would have saved $130,000 of your working wages, but that $130,000 investment in September of 2021 would be worth over $1.9 million.
That's a great system.
It's
look at that.
amazing.
Look at that multiple on that. That is an incredible system. You take $130,000, turn it into almost $2 million, $1.9 million. Man, if that was in a Roth account, you're going to be tickled.
Tickled.
But we all know. Let's be realistic. Nobody has the ability to know exactly when we've reached the dead bottom of the market. I think you would drive yourself crazy with this whole timing component.
Yep.
I mean, you even have a saying, we've heard it, I can't even remember who came up with it, but it's about the timing versus time. How does that saying go?
Time in the market is always more valuable than timing the market. You want to make sure you're on the right side of that equation, because this showed that timing the market turned out well if you got it exactly right. And I mean exactly right. But what if you didn't do that? What if you just wanted to do time in the market?
Yeah, so we have 20/20 vision looking historically. Nobody has that. So let's think about what we can control. What if instead of building up, buying at the dead bottoms, what if we just bought same amount of money, still took the same $12,500 of income in 1980. That was kind of the average median income back then. Then took 25% of that, $261 a month, and just invested it every month the index.
High or low.
We didn't have to worry about whether the market was going up, whether the market was going down. We just bought every month.
What's amazing is at the end of that period, you would have still saved the exact same $130,350, but because you were consistent and not trying to time the market, but you were spending time in the market, your portfolio would be worth almost $2.25 million. You actually did better than the world's best investor that hit the bottom of every single market.
I mean, that's a greater than $300,000 difference without probably paying. Because if anybody had a crystal ball, you think about Back to the Future, Biff got the sports almanac.
That's right.
That would be worth something. You probably could say, hey, I'm not only going to be Warren Buffett, I'm going to go harvest money or offer to manage people's money and tell them I have the sports almanac or I have the ability to time the market. You'd probably have a lot of people sign up, and you'd actually
you'd sell a
do
ton.
them pretty good, because you'd turn that $130,000 into $1.9 million. Everybody'd probably be pretty happy. But the reality is you don't need the system. If you just were buying every month, you could turn it into 2.25, almost it's an over $300,000 advantage for the person that had zero system. You don't need the DeLorean, you don't need the time machine, you just need to keep it working.
And what I think is beautiful is people always say, oh, well, you guys are just cherry picking. You're picking the S&P 500. Everybody know the S&P 500 is just an amazing investment. We thought, okay, well, let's just look at what do some other types of investments. Again, if you want to be passive, if you want to look at indices, if we look from 1985 through 2020, yes, U.S. large cap has annualized about 9.6% per year over that time period. But maybe you pick a different index, like U.S. small cap investments. It's averaged about 9.1% per year. Maybe you want to be an international investor. International investments over that same time period have annualized 7.6%. Or even if you were a scaredy cat and you said, you know what, I don't even like all the equities, I don't like all the risk, I'm just going to buy bonds. Even U.S. bond aggregate investments over the last, from 1985 until 2020, have annualized over 4% per year. So it's not like you even have to be the smartest investor or pick the absolute best investment. You just have to get in the game, and you can be successful as a long-term investor.
Before we talk about who is successful and who's the system rigged for, I think it's worth noting we showed that JP Morgan had research that showed that the typical investor over the last 20-year period has really only made a little less than 3%.
The active investor, that's right.
Now, I look, interest rates are doing some crazy stuff, so I don't know if it's reproducible for the future, but even the bond indexes did better than what the typical investor did.
Right.
You can imagine, and a lot of you are probably sitting there going, wait a minute. Speaking of, this might not happen again. We've had a lot of great returns in the market. Is that just completely going away? And, there's a lot of negativity, especially we've done shows where we've talked about Vanguard has predictions that the market's only going to make 3%, 4% for the next 10 to 15 years. Why do I feel comfortable saying I think you should still be optimistic? Why it's still a good time to be an investor? Guys, realize I want you to think about the last 5 years, 10 years, 15 years, all the innovation that's going on. Think about what's going on with technology. Think about how you interact with your cell phone, with the internet. Things are accelerating. Look at how electric cars are changing the automotive industry. Look at how everything is moving so fast right now that it's accelerating. And this innovation, there's always going to be ways for you to make money off of it. So you don't have to go get so smart and figure out each individual stock that's going to be successful. You just buy the market and know that you're counting on humankind to continue innovating, to continue to grow. You're buying into every part of that.